I'd like to welcome you all to the last webinar in the Macroeconomics series. This one is addressing B2B, Capex, inventories, and investment considerations. My name is Joanna Truitt, Executive Director for the Association Education Alliance, of which your company is a member through your association membership. Displayed are the associations participating in these series. As mentioned, each is a member of AEA, which is a consortium of distribution-focused trade associations. I have the pleasure of introducing your presenter in the series. Most of you know Alex Tchaikovsky. Alex is a highly experienced market researcher and analyst with more than 20 years of expertise across subjects, including economics, industrial manufacturing, automation, and advanced technology trends. For the past 2 decades, he has consulted and advised companies throughout the US, Canada, Europe, South America, and Asia. And he is currently overseeing a suite of analytic products focused on talent for the Miller Resources Group. He is also consulting with companies to help them become better at attracting, hiring, and retaining the impactful players that they need to succeed. Alex.
Thank you so much, Joanna. I appreciate the introduction as always, as I appreciate all of you taking time out of your busy days to join us for this informational session brought to you by the AEA. And today I'd like to start by revisiting the last question we had in the May session when we were talking about the debt ceiling. I assured you that it was mostly grandstanding and that we were going to get a deal. Thankfully, that did come to pass. We are no longer under threat of default, and so things are relatively rosy when it comes to government affairs meddling with our economic prospects as we look out to the future. We have covered several different elements of economic performance over the last couple of months. We talked about the consumer side of the economy during our April webinar, and I assured you that consumer was still in good financial standing. They had jobs, they had both the willingness and ability to spend money. Last month, we talked more on the commodities and the pricing side, and I peeled the curtain, if you will, back a little bit on what drives commodity prices, what you can expect in the future, and really what it means for your business from a margin focus and a profitability perspective. And today we wanted to talk about things that really matter as a distributor organization, as a distributor company, that you care about from an operations perspective. And that's going to be what's going on in the industrial economy, what are the prospects for investment as we look out to the future, and what is happening with inventory levels. But most importantly, as always, I will seek to uncover what all of that means to you as distribution business leaders, as key decision makers for your own respective organizations. And so I'll look to provide you with some very practical, actionable advice that you can then go back and implement within your own businesses to prepare yourself for the second half of this year and for 2024 and beyond as well. So let's start our conversation today by looking at the industrial economy from a macro level. One of the best ways to do this is by tracking an index called U.S. industrial production. This is put out by the Federal Reserve Board. And in this first chart, I'm highlighting to you basically the top level data summed over the last 12 months and plotted over time. So this dark blue area shows you the actual value of industrial production as an index. Now, keep in mind, this is not dollar denominated. This is actual volume. And so the factors of inflation have been stripped out here. And you can see that on face value, we are in a very good position right now. So current levels of industrial production are not quite at record high, but they are the highest levels since September 2019. So certainly from even before the pandemic, we haven't quite reached that peak that we saw in late 2019, early 2020, but we're not far from it as well. Looking at this data, you can see we're on par with kind of the previous peak that happened around 2015 and above the pre-Great Recession peak back in 2007. This data highlights the fact that we have enjoyed a very solid performance. The rebound from the downturn that you can see here, which was, of course, the pandemic-driven recession, has been quite robust. It's been very aggressive, and it took a shorter period of time than previous recessionary periods have taken. That's the good news. But in order to really ascertain what's going on with the data, we can't just look at the face value. I like to make the allegory relative to, think about a person. What you see on the outside is not always telling the full story. You really need to look at the vital signs of that individual, the blood pressure, the cholesterol levels, the heart rate, and then you can tell how healthy or not healthy that person is. You can't judge a book by its cover. So looking at the same data for industrial production, but as rates of change, as opposed to the top level, what we see is quite a different story. So I'm plotting something called the business cycle for you here, and it's essentially two sets of growth rate. The orange line is showing you the quarter over quarter rate of change. So let's say plotting all of Q1 of 2023 and comparing that to 2022, the same period of time, and then plotting that as a growth rate. And then the dark blue line here is the year over year rate of change. So a couple of things really emerge here for us that we couldn't see before. First and foremost, we see that we have peaked. We are well past the peak in the industrial economy. That's what this series represents. And we have been decelerating for the better part of a year now, in some cases more than a year, if you look at the shorter term orange line, which is, of course, that quarterly growth rate. We can also see that we're trending towards zero. So the shorter term rate of change, the quarter over quarter one, is now just at 0.4%, very close to that zero mark. The year over year rate of change is still relatively healthy at 2.1%. But the interplay between these two series point to further deceleration and downward pressure on the industrial economy over the next 2 quarters or so. Anytime you see this shorter term rate of change below the longer term one, it's going to act as an anchor. It's going to pull down that annual number. And I believe that by the time we get into the latter part of 2023 and certainly into early 2024, we're going to see some negative values on the industrial production index, which is essentially a mild and relatively short industrial recession that's in our near-term future. Now, I don't think this is going to come as a surprise to many of you. I know that many of the organizations that I talk to on a regular basis are already starting to feel the slowdown, in some cases, depending on the industry, quite profoundly. But I do want you to understand that beyond the deceleration and the short-term contraction that we're expecting here, there's also some evidence of the next rising trend, which should likely manifest by the second half of 2024. So don't just focus on the negative. Think about how to make sure to weather the storm and then position your business appropriately for that next up leg in the business cycle and the acceleration that is likely to take place about 12 months from today. Another way of looking at the industrial economy and determining how healthy or unhealthy it is by looking at investment value. And investment is actually tracked in dollar terms by a series called non-defense capital goods new orders, excluding aircraft. We strip out the value of airplanes because they're such large ticket purchases. We look at machinery, we look at investment into other goods, both durable and non-durable, and we plot that over time. So what you can see in this chart is that value, again, the face value, the dollars associated with Capex or investment activity. And in this case, what you can see is not only the fact that we are at a record high, but the fact that we are way beyond anything that we've seen over the last 25 years. You can see the previous peaks were all around the $800 billion mark. We're now at about 875 or so. And that's clearly reflective of two factors. Number one, that we've had a very robust period of investment in the US economy. And number two, that some of that investment and that acceleration that you can see here in the data has been reflective of inflationary pressure. Because this is a series that reflects dollars, any change in pricing environment, particularly to the upside, is reflected in higher values here. And that's what we're seeing manifest itself in terms of that record high. It's a combination of organic growth, just because of the large amount of demand that has existed in the US economy for these capital goods over the last 2 years, but also on top of that, is the increase in prices that we've seen over the last 2 years. And that contributes, both of those factors contribute to this record high that you're seeing. Again, delving into the vital signs of this series shows you that things are similar to what you saw in industrial production, and you'll be able to see this relatively consistently, no matter what industrial or B2B related series that you're looking at, with the exception potentially of like defense and aerospace, because those tend to be counter-cyclical and of course fueled by the war and the investment that we have into the Ukrainian conflict right now. But in terms of overall Capex, you can see we are slowing off of a peak that was on par. If you look at this yellow, orange line, which is the annual trend line, on par with the boost that we saw post-Great Recession. But we're now slower than that, 4.8% growth year over year, 2.6% quarter over quarter. And as I mentioned in the industrial production case, it is decelerating. It will continue to slow. I don't think that it's going to go as negative as we look at in terms of industrial production. There, you're probably looking at, a single digit, probably low to mid digit type of contraction. Here, because of that upward pressure from inflation, we're likely going to see a little bit more of a soft landing. So it's probably going to skirt somewhere around the 0 line. Some of that negativity will be offset by ongoing increases in pricing, although customers will push back on those more and more because they are becoming more sensitive in a weakening macroeconomic environment. So the story is consistent between both the volume tracked by industrial production and the actual value of activity in terms of Capex investment. As you can see here, both of them are currently slowing. The volume is likely to see some mild contraction. The value associated with that activity is likely to have flat to, potentially marginally positive growth over the next 2 to 3 quarters before that next rising trend ensues. So as you think about all of these things, you have to think about it in 2 different ways. Number one, you have to yourself adopt a little bit more of a defensive, conservative posture in terms of the investments that you're making, the money that you're spending, and make sure the ROI for all of that is there, and make sure that the timing is right for it. And then secondly, think about it from your customer's perspective. How can you leverage the still existing optimism within your customer base to make sure that you soften the weakness that is coming based on these data series, and make sure that you, moderate some of that decline for your own business and position yourself again to take advantage of the next step up in the business cycle, which we expect to happen in the second half of 2024, and certainly much more acutely in 2025. Now, bringing all of this down to the inventory level, we're going to see a very similar story unfold. That's the nice part about all of these data sets, is they are interrelated and they do see some typical consistency in terms of movement. So again, this is data from the Census Bureau. This is the dollar value of all merchant wholesaler inventories. You can see by far and away, we are in record territory around 11. This is in the $1 billion now that's being held in inventory. And once again, digging deeper into the data, we can see that that growth rate is slowing. So both in terms of the annual rate of change, you can see this is the latest data through May. We have seen a turnover now, and it's decelerating. The quarterly growth rate, which is shorter term, has actually been decelerating for the better part of 3 quarters now, and is lower in terms of its relative position to the annual growth rate. You can expect that type of momentum to the downside to continue in terms of inventories, and potentially result in some destocking of inventories as we get into the latter part of 2023, into the early part of 2024. But there's not going to be anything like what we saw back here in 2008, 2009, nor do I expect the kind of inventory destocking that took place during the pandemic in 2020 and early 2021. So again, cautious optimism, moderation, but nothing overtly scary out there. The real takeaways that you can glean from this reside in applying the same kind of analysis that I've just showed you for industrial production, for Capex, and now for inventory levels to your own individual business, because you can get some great insights from that. So this next chart is going to have you show you a sample of an actual company. This particular company is in the business of making welding equipment. And I want you to see how the interplay between the face value or the top line numbers and the growth rates really lead us to have greater insights into what we should be doing as business leaders and key decision makers. So you can notice the timeline here. It starts in 2018 and then goes through early 2023. I want you to notice that as the company revenues here were rising over the course of 2018 and into mid-2019, we saw a trend reversal in those growth rates. So that orange line actually downward past the blue line. In this case, the orange line, again, quarterly growth rate, the blue line, annual rate of change. And it's really giving us the preview by being below the blue line that our revenue is not going to continue to rise. It's actually going to start to plateau and then eventually decline, depending on how long and how severe this negative trend lasts. So what happened here? Well, we certainly saw that revenue decline occur as we got into 2020, because that orange line, of course, was trending slightly lower prior to the start of the pandemic, and then essentially fell off a cliff here during the pandemic. So here we see this capitulation, we see the downward movement. It's finally picked up by the top line revenue here. But also what we're seeing is a reversal in that trend. So back in, this looks to be May or perhaps June of 2020, we had a trend reversal, and the orange line not only started rising, but it actually upward past the blue line by the fall of 2020. Now, notice down here, we don't see any upward movement in that revenue by this period of time just yet. So if you're only tracking your top line performance, you're going to miss what these signals are telling you about your business. But if you do pay attention to the rates of change, then you'll be able to say, aha, I have a trend reversal. The orange line now has consistently been above the blue line for at least 3 consecutive months. I can expect my top line revenue to start increasing. And that's exactly what this business saw over the next several years. You can see they essentially doubled in revenue from just over $20 million in 2018 to almost $45 million by the time we got into early 2023. And so they're probably feeling pretty good about themselves. But again, it's important to pay attention to those growth rates. You can see here in late 22, early 23, that rate of change once again crossed through the blue line, and that is a harbinger of things to come. So I have kept in communication with this company. They're really starting to see meaningful drop-off in both demand and orders now. But we have been having these conversations, and they've been making plans, preparing for what levers they're going to pull when this eventually starts to manifest themselves for 2 whole quarters. So we have different scenarios mapped out. They know exactly what they're going to do if revenue is down 5% versus if it's down 10% versus if it's down 20%. And so it's no longer a guessing game. It's no longer a game of reaction. It's now proactive thinking, making sure the right things are in place, making sure you have a plan of action, and then implementing and executing that plan as the various scenarios unfold. It's a very, very powerful predictive analytics tool by looking at your own growth rate. And it doesn't cost anything to do this. If you're interested to learning more about this, I'm happy to teach you the methodology. Please feel free to reach out to me, connect with me on LinkedIn, and send me a note, and I'll happily schedule a call with you to go through this in more detail. So this gives us the idea that the next 2 quarters or so are going to have ongoing downside pressure. We saw it in the macro environment. We're seeing this in the individual company data. But what about beyond that? What do we think about the likelihood of this recession becoming more severe and longer in duration? Well, there's a way to tell that too, and that involves using leading economic indicators. How do those work? Well, first, you have to understand what they are. A leading economic indicator is, simply put, a data series that accurately and consistently predicts what another data series is going to do over time. So in this particular example, I've got a leading indicator as the orange line and an underlying set of industry data that we're trying to predict here in the blue line. What you'll see is that the peak here, notice this 2009 rebound, happens in the 4th quarter of 2009 for the indicator, and it doesn't happen until the 4th quarter of 2010 for the underlying data series. And we can see this 4-quarter relationship consistently manifests through the low and high points of this business cycle. So here the low predicted this low called for that low, this peak for that peak, and so on and so forth. You can see the orange line is always leading the blue line. Once we establish what that lead lag relationship is, in this case, 12 months, we could then actually leverage that knowledge to see around the corner for the underlying set of industry data. How do we do that? We look at the past 12 months of the leading indicator. Now, keep in mind, this is not a forecast. It's not a guess. This has already taken place. And we physically push it forward by 12 months, aligning those two data series on top of one another, matching the low and high points in the cycle, and then leveraging the last 12 months of data here to predict what the blue line is going to do. And this is a very, very powerful planning tool, because each of your companies, each of your industries has its own underlying set of leading indicators that can consistently help you with planning and strategic efforts in terms of seeing around that corner. Let me show you how this works in practice. So in this particular case, I'm going to use the US Industrial Production Index as my underlying data series, the overall industrial economy, if you will. The first example I'm giving you is plotting US industrial production, again, that dark blue line, against the total industry capacity utilization rate. That has a 6-month lead time relative to the index, and it actually measures the percentage of current infrastructure, factory space, and production capacity that we are using right now to meet existing levels of demand. And very easily here, you can tell that the shifted forward perspective of capacity utilization says, prepare yourself for that blue line to continue decelerating and eventually enter that mild negative territory by the time we get into late 2023, early 2024. There are other series that have longer lead times. A great example is copper future prices. Why copper? Simply put, because of its diversified usage in so many different industries, from automotive to electronics to consumer goods to construction. Copper is really pervasive in our industrial economy. And here, once again, you can see I've shifted this forward to the right by 9 months, and it's pointing to that downside movement in the blue line over the next 3 quarters. One of my favorite leading indicators is actually the US ISM PMI, the Purchasing Managers Index. In this case, I'm showing you the month-over-month growth rate that you can see that here, and the 12-month lead time. And you can see 2 things that I find very interesting in this chart. First, the confirmation of that low point happening likely in late this year or early next year, and then some marginal beginnings of that next rising trend, showing that we're going to start to see that rise likely manifest in mid-2024 to the latter part of next year as well. So you can use these leading indicators for your own business or others that you identify for yourself to see around that corner to aid with your strategic planning. This particular one I added just for this group. It's the total goods wholesale inventory over sales ratio versus US industrial production. And what you can see here is that what happens with inventories actually has a great deal of predictive abilities in terms of what happens in the industrial economy overall. Now, it's not a very long lead time. I will admit to that. It's 4 months into the future, but you can really see this inversion because this particular data set is actually flipped around. It's inverted. And it is showing you that there's going to be that downside pressure on overall US industrial production. And this is coming directly from the wholesale industry. So it's distributors across a wide spectrum of different vertical markets. Their inventory sales ratio does have this predictive ability. So it's very interesting to see the interplay between your sector and what goes on in the industrial economy overall. So I promised you actionable, practical advice, and we're going to start with the basics, right? First, you really have to start tracking your own business performance. If you aren't already doing this, you're missing out on key insights. It doesn't cost anything. It's relatively simple math. You just have to allocate someone who's responsible for it, and the insights you can get from that behavior are going to be very valuable to your decision-making as you move forward, both in terms of your quarterly and your annual totals and growth rates, and it allows you to infer both the momentum in your business and the directional movement over the next 6 months, roughly speaking. Then you couple that inference of the rates of change with the top 3 to 5 leading indicators that you track for your own organization to see the longer term perspective of what you can expect for your business and to aid in your strategic planning as well. Here are the real kind of operational advice that I would share with you as you think about the next 6 to 12 months. So first and foremost, we've seen the environment in the lending space. We know what interest rates are doing. Typical business loans, depending on the credit worthiness of your organization right now, are somewhere between 8 and 10%. So you have to focus on optimizing cash flow. Assume that there are no attractive financing options available for the next 12 to 18 months. Any projects that you want to undertake, any investment you want to make, better off doing that with cash rather than investing, or borrowing money at that 10% cost of borrowing that's out there right now. From a focus perspective, you really want to double down on those parts of your business that are outperforming right now, both from a sector and an application perspective. So if you have products, services, and parts of your business that are clearly laggards, those are the losers, and you cannot afford to spend time servicing and selling the losers during a period where customers are being very selective. So you really have to narrow down that focus and really push the stuff that's outperforming relative to the rest of your offering to the marketplace. At the same time, you have to recognize that you can't just chase those big accounts. You can't be a whale hunter only. You have to take every potential win that you can get, because I'll use like a fishing analogy here. So let's say you're in a little paddle boat. You've got a giant lake. Well, go to the part of the lake where you know the fish are and post up there. Don't try all of these different things all around the lake. And then when you're there, realize not all the fish you're going to catch are going to be giant winners, right? Some of them will be smaller, some will be medium-sized. That's the kind of thinking in terms of running your business that I want you to have. Focus on the outperforming stuff and then take whatever you can get based on the weakness that we're expecting over the next 12 months. Realize while you're doing this that during typical periods of macroeconomic slowdown and outright contraction, lower and mid-tier, or the cheaper solutions and product offerings, likely lead during this period of time. They outperform. And so you've got to focus on that part of your business. The more highly customized, the more engineered products are going to be more difficult to sell during a time when customers are more cost sensitive and are tightening their own belts. We also see a big shift towards aftermarket service and support, replacement parts, the MRO part of the business. That is going to be increasingly key over the next year, as well as companies decide to buy less new product and make do with what they have and reuse and repair and instead of replacing it with new products. I think this is a great time to take the lull in relative slowdown in activity compared to what you've experienced over the last 2 years, and really invest in that build out of the channel and partner ecosystem. Create a moat around not only your business, but your suppliers and your customers. Kind of really get everybody on the same page and look for collective win-win scenarios. It is not a zero-sum game. It is not in order for you to win, when somebody has to lose. No, look for opportunities where both you and potentially your suppliers or your customers are able to win all at the same time. And then probably the most important piece of advice that I can give you is there's still quite a bit of companies that are positive in their investment posture right now and their mindset. Lock in that business whenever it's possible. Even if you have to give a little bit of a discount to extend the contract terms, if you typically sign a 6-month or a year-long contract, but you're able to extend it to 18 months or 2 years, absolutely look for opportunities to do that. It's going to soften that downside pressure during the economic downturn, allow you to come out of it in a stronger position, and then to catapult you out into that next growth phase that's coming in the second half of 24 and onward into 2025 as well. So your current customers in that scenario are likely going to be your best allies and your likeliest growth vector as you look out over the next year. So I hope you found both the macro discussion and the specific operational advice that I've provided here valuable. I wanted to make sure that we left plenty of time for Q&A, since this is the last webinar in this 3-series cadence that we have going on. I hope I get to continue working with the AEA in other opportunities in the future. But in the meantime, I wanted to say, again, thank you for your time. We're going to take some Q&A right now. And as I encouraged you several times throughout the webinar, please connect with me on LinkedIn. I'd be happy to discuss any of the topics you heard about today or over the last 3 months with you directly. But at this point, Joanna, I'll turn it back over to you, and let's do some Q&A.
Yeah, absolutely. We have one question. Curious what data suggests that destocking won't be as bad as prior recessions. Distributors carrying double normal backlogs and higher inventory, why won't that adjust back to historical norms?
Yeah, that's a great question. So if I understood correctly, that the data suggests that the inventory destocking won't be as severe as we've seen in other periods of time. And I think that a big driver of that is that the supply-demand fundamentals have really shifted, right? So you mentioned the bigger backlogs, the larger order books that many companies have right now, particularly with the big, kind of durable good type of products that last 3 years or longer. So that's part of why customers and distribution companies should be expecting higher levels of inventory relative to previously. I also think that there is going to be opportunity at the industry sector level. So I think that there will be some sectors affected more profoundly. For example, if you look at machine building, that industrial production series is much more negative than looking at chemical process production, for example. And so it's going to vary substantially from industry to industry. But overall, I think that there's just a more robust level of underlying demand that we will have had coming out of previous downturns. This has been talked about as one of the most telegraphed recessions in recent history. We have a lot of time to prepare for this. And so a lot of people, for that reason, believe that it's not going to be as painful or as long lasting as typical. And I share that opinion. So I think that we're going to come out on that next level of growth from a higher base relative to what we've done in the past. So I think that there's a multitude of factors that aligns with higher inventories, at least relative to previous downturns where we've seen a much more significant destocking. This reselftion, as I've called it before in the past, is, I think, going to give people plenty of time to prepare, to think strategically long-term. And as a result, they'll have more confidence that that next turnaround is coming once we start to take off the pedal, the foot from the pedal on interest rate policy. We're actually expecting 2024 to see some substantial downside movement in terms of rates. That's going to stimulate investment and should pick up on that next positive leg forward sooner than we would have in other downturns. So apologies for the long-winded answer, but there's a lot to discuss there. I do think that the general theme, though, the concept of inventory levels not being as depleted as in previous downturns is true.
Another question came in. It seems that the lack of existing homes for sale is driving new home construction, even though mortgage rates have been rising. Do you agree?
Yes, there are some really interesting things going on in the housing markets, and certainly we are seeing a lot of activity for the builders because there is a massive disconnect between supply and demand. I think that we still have a long way to go in terms of digging out of that hole. To put things into some context for you, prior to the Great Recession, the average rate of new home construction in the US economy was about 1.6 million units per year between single and multifamily. Now, we are not even at 1 million units per year, and we haven't been over the last 15 years since the Great Recession came to an end. So we have a lot of making up to do, and we have that combined with the fact that millennials and older Gen Zers are now getting to the point where, yeah, they do want to get married and have kids and raise a family, and so they do want to be homeowners. Now, this obviously rising rates, mortgages being 6, 7, recently as high as 8%, is definitely a debt as the federal funds rate is expected to come down. The long-term position of the Fed is that they want that federal funds rate somewhere around 2.5%. And so what that means, Joanna, can you still hear me?
Yes.
Okay, fantastic. Sorry, there was a little interruption there. The point that I was making is that the Fed has clearly said that their long-term goal for that federal funds rate is about 3 percentage points lower than where it stands today. So today we're somewhere between 5 and 5.25. Longer term, they're looking to get it back down to about 2.5, which means mortgages are going to be much more reasonable, let's say, relative to what's going on right now. We're talking about somewhere in the 4 to 5.5% range. So it's not going back down to, the 2.75, the 3.5% that we saw for a long period of time when interest rates were at zero, but they are going to normalize. So all of that is to say that I think the housing market is going to come out of the slump that it's in right now. It's just going to take about 4 quarters for it to do so.
Another question, what are good sources of raw data to calculate rates of change for our own analysis? FRED, the St. Louis Fed, is one source I found, but there is a lot to sift through.
Yes, you're absolutely right. So I will answer this question in 2 different aspects. First and foremost, tracking your own data starts with your own company performance metrics. So it's literally any data set that you think is reflective of the performance of your business. I've seen companies track revenue, obviously, as a great starting point. They've tracked volume, if it's more of a kind of a homogeneous product, anything bulk material related. I've seen companies track order volume. I've seen them tracking, shipments, profitability metrics, and even things like quotes issued by your sales department. If you track that on a monthly basis, you'll definitely start to get a kind of a forecast of what's going to happen with orders and then revenue down the road by tracking the number of quotes your salespeople are putting out there. So that's one element. And by the way, I thought I'd mention this. I do have a podcast that I run called 3DM, the podcast. It stands for Data-Driven Decision Making. And there I actually talk about some specific strategies for companies to leverage data analysis when it comes to their performance metrics, economic data, and other business intelligence like market sizing, market share analysis, and so on, and then people analytics. So if you want a lot more details on how to do that, check out the podcast. The second element that I would mention, you highlighted FRED. FRED is essentially a platform that pulls data from many different sources. Now, there is a very handy data pull-down menu. So it's not just the charts that FRED generates itself, but there's a download data button at the top of every chart that you can actually pull it down for analysis. But the underlying data sets don't come from the FRED. There are, I would say, 2 key sources of information. One is the Federal Reserve Board, or FRB, economics world. They produce a lot of the production level data. So industrial production, machinery production, lumber production, things of that nature. And then US Census Bureau produces series on new orders. So the production series, again, are volume-based. New orders are dollar-denominated metrics. And there's everything from machinery production to various components to various materials. So those are the originating data sources. FRED just kind of pulls that data together. But I think more than identifying and having access to the data is the understanding of how to read and interpret the data. And that's where most companies need help. And I'm always very happy to hop on a call with you and walk you through the process of what I think you should be doing and describing the methodology of how you can implement that as an ongoing process within your organization. So please take me up on my offer. I'm happy to talk to you anytime.
Can you comment on how AI will impact the economy? Is it a new industrial revolution?
This is a really, really fascinating question to me. And I think in order to answer it, I will talk about the historic implications of any revolutionary technology that we've seen. There's always a lot of fear and anxiety about the impact that it's going to have. We saw this with the advance of computing in the early 90s. We saw it with the advance of the mobile phone environment and people really shifting to individual devices, where we basically took the internet mobile around 2007 when the first iPhone was launched. I believe that this is a next leap forward in the industrial revolution, if you will. I think that overall, it's going to be a positive factor for both the US industrial economy and for individual companies. I think it's going to allow us to gain productivity. If you look at productivity in the US, particularly in like the manufacturing distribution space, it's been really stagnant over the last couple of decades. So we really haven't seen the type of productivity gains that we need to have, in order to continue expanding the economy at a robust pace. And that's one of the reasons why our growth rates have been stagnating over time. If you look at GDP or industrial production, they're still positive, but they're not as positive as they were 10, 20, 30 years ago. So it's important to recognize that this is a technology that has really tremendous potential to help us gain productivity, shift some of the more mundane, low value add tasks to machines, allowing people to engage in more creative, in more unique, individualistic type of pursuits. And so I don't think it's going to be net destructive to jobs. I think that we're already starting to see signs, for example, in the IT sector. Many of the high-tech companies, Google, Amazon, Apple, Netflix, the list goes on and on and on, that had those massive layoffs, like in the last 12 months or so. Those people are finding new jobs in areas, particularly in startups, having to do with AI. And so I think it's very difficult for us to project far out into the future, but as long, and this is an important caveat, as long as we treat the implementation of AI responsibly, as long as we legislate how it can and cannot be used, as long as we make sure that companies are following the rules, I believe that it's going to be a very good thing for US economic growth, because we are at the forefront. Once again, we are leading the way in terms of AI development because of our risk-taking profile, because of our creativity, and our propensity to start new businesses around new technologies. So I'm very bullish on the overall positive impact that AI can have on the US economy. But again, I think it's going to be very critical for us to establish norms of operation that are going to protect us from the potential technology as well, because I know that I talk to the cyber community quite regularly to make sure that I'm kept up to date on the latest developments. And somebody shared with me this example that I've just found so compelling. So AI now has the ability to generate both video and audio from text. They also have this ability to generate deep fakes, right? And so if you apply AI in a way that can actually, this example really blew my mind. Like, for example, imagine getting a Teams call from someone who you think is your boss. It is their likeness, it is their voice, and they're telling you to do something, but you don't know that it's actually some hacker or somebody else on the other side. That's a very huge vulnerability for organizations, right? Because we don't know what to trust and what not to trust. Now, AI has the capacity to do that. Generate a fake image in the likeliness of your boss with your boss's voice, giving you instructions on what to do. We have to be very cognizant of that, of the potential for disruption and the risks involved. But as long as we treat it in a diligent manner, I think long-term we're going to be beneficiaries of this next leap forward in AI development.
And then the last question was whether or not you could put the name and maybe a link to your podcast in the chat.
Sure, I absolutely will. The easiest way to connect, if you look on LinkedIn,
QR code. Yep,
use that QR code. My LinkedIn, I put snippets of the podcast on a regular basis. So just go back through the last couple of weeks of my posts, and you'll be able to see a link to the podcast. It's on, it's on the Apple Podcast. It's on Google. It's all prevalent, and it's free. So check it out. Definitely worth your time to do that.
Good deal. Well, Alex, we don't have any more questions. Again, just want to thank you very much for the great information that you've shared with the group over the last 3 months. Again, like to thank all of you who have participated. There are recordings of these sessions that are sent to your associations. They'll receive them within probably the next day or two. So again, please touch base with your association, check the website if you'd like to hear a recording of this particular webinar. Thank you, Alex, and thank you all very much for your participation.
Thanks, everyone. Have a great day. Take care.